I'll just go ahead and get started, and Luke, I'll actually throw it to you first. So I'll go fairly quick this time. I'll keep it even briefer than I usually do. Yeah, thanks for everybody who's migrating over from Discord. Also, thanks to everyone who's joining us for the first time. Essentially, these calls are just a dedicated time each month for us to just talk about everything related to Moonwell governance. Could be new core market proposals, risk updates, vault updates, protocol upgrades on the technical side. Things of that sort. Just to note, the calls going forward are going to take place on the last Thursday of each month. They previously were on the first Thursday of each month. The next one will be March 27th, I think. And yeah, the last thing before I hand it off to the first speaker, I usually have visuals to go along with the call, but since we're over on Spaces now, we'll just have to fly blind here. I'll be adding visuals to the YouTube recording when it goes live in a couple of days. And yeah, that's going to be it for my intro. I guess one of the big things we're going to cover for the call today is the topic of protocol reserve auctions, which they're fairly complex from what I've heard, and I'm not qualified on them to speak on them at all. So I'll go ahead and hand it off to Luke.
Sounds good. Thank you. Appreciate it. Good morning, everyone. Good afternoon, wherever you are. First, I just wanted to thank everyone for joining the call today. I know that governance can be a boring topic sometimes, but it's also really important to help secure Moonwell. And we all kind of have to play our part, whether we're a contributor or just a voter. And I really appreciate how much engagement we've had in the forums recently. And I also want to just let everyone know how much I appreciate all the high quality governance proposals that have passed recently. In just the last few weeks, we've launched so many new markets, including a market for virtual, the AI agent launchpad, a market for USDS, the new Sky Money stablecoin, and also markets for Lombard Bitcoin and Threshold Bitcoin, my bad. And so we now have 3 Bitcoin derivatives on Moonwell on Base, and we also have one of the highest quality agent launchpads as a token. And this sort of reaffirms our approach of launching the best assets on Base and being the best Base native lending protocol out there. First, just thanks to everyone that voted or contributed to those proposals. Really appreciate you, and thanks to all the different teams that helped us get the correct information so that we could do the risk analysis. And thanks to Gauntlet for doing the risk analysis on those new market ads. That's what keeps us innovative. That's what keeps us ahead of the competition out there. And the competition is really starting to heat up on Base, which is a great sign because we're building this new on-chain economy together, and it's going to be the biggest on-chain economy in the world. I'm excited about building it together with everyone here on Base. But let me just jump into this proposal because I want to be efficient with our time, and there's a lot of stuff to get through. So first of all, this is a proposal that we kind of have been brainstorming over the last few months with some other Moonwell contributors, including Solidity Labs, and we've also been talking to the legal counsel for Moonwell Foundation, and we have onshore and offshore counsel because Moonwell Foundation is a Cayman domiciled charitable foundation that's chartered with growing the Moonwell protocol and ecosystem. So we've been talking to a lot of stakeholders and just bouncing ideas off them. And I wanted to share this idea that I had to kind of help just generally make the Moonwell protocol more efficient and operate better for all those involved, especially those that are most loyal and actually stake in the safety module and help to backstop the protocol and contribute to the shortfall insurance program. So first of all, just to recap, you might remember last fall, we voted on a voting requirement, or we had like a forum post and then a temperature check vote. And then we had, I believe, 2 on-chain votes to enable a voting requirement for people that stake in the safety module. And basically that voting requirement says that you have to vote in governance at least once every 30 days in order to claim your staking rewards. You won't ever lose your staking rewards. It just means you couldn't claim them temporarily until you vote on a snapshot temperature check proposal or you vote on an on-chain proposal. And so we're trying to basically help increase voter participation because it's so important to secure the protocol. We have to worry about activist investors now that Moonwell has more attention. And there's a lot of bad actors that might want to take over the protocol and upgrade it in ways that would be harmful to the rest of the community and to the projects and assets listed on Moonwell. So, as members of this large community, this ecosystem, we really want to, kind of help everyone to make sure that voters are engaged because that's ultimately the best solution to the activist investor problem. And we've seen in other protocols like Compound where the Golden Boys basically took over the DAO, and that was a vote that happened on a weekend, and actually they had tried, I think, 3 times previously to put up a bad vote, and they'd failed, but it was on a weekend and voters weren't paying attention, and they eventually did win that governance vote. Now, I think they, negotiated with the Compound team and, were able to kind of cancel the proposal, but the damage was done. The Compound DAO had to basically give in to the demands of the golden boys. And so we want to avoid creating scenarios like that in the Moonwell protocol, because obviously that's always a bad outcome when a few well-funded actors can kind of take over an entire protocol with 9 figures of TVL. That would be the worst possible outcome. So this is a part two of an effort to increase voter participation and also to reward those that vote more often and that stake in the safety module, because you are basically our most loyal community members and you're the most engaged in the success of the Moonwell protocol. So let me walk through this proposal with you, and then I'd love to hear feedback if there's any questions. And also, I believe Gauntlet is here to talk about their risk analysis of this, because I've requested that Gauntlet provide some risk analysis and help us determine what are the right amounts of reserves to keep in the markets. But let me pause there and walk through the proposals. If somebody wants to maybe share a link to the forum post, feel free to walk through it with me. But basically, the takeaway here first is that Moonwell is generating a lot of protocol revenue and fees for lenders right now. We've seen a lot of success in 2024, and even in the kind of bear market conditions, the sideways chop we're in right now, we're still seeing really good fees and revenue generation. I think we're seeing over $2 million in fees generated for lenders every month. And in December, there was almost $387,000 in revenue generated at a protocol level. Now, what happens to protocol revenue? You might ask yourself. Obviously, the fees to lenders get earned by those lenders, and that's great. That's why people love using Moonwell. But the protocol revenue today just stays in the markets as reserves, right? There hasn't been regulatory clarity that would allow DeFi protocols like Moonwell or like Aave or Compound or others that are similar to us to basically turn on a fee switch and pass those through to well holders. That would be too much regulatory risk. It's the same reason why you haven't seen Uni or Aave or Comp or any number of other protocols turn on a fee switch. But we think we can be more capital efficient and use that revenue in a different way. So I had this idea, and then also this forum post walks through how we've been laser focused in the community on building more protocol revenue, because we are the most capital efficient lending protocol on Base and on the networks we're deployed on. And as part of that, we've been really focused on launching the vaults that we partnered with Morpho on. Those generate curator performance fees that go back into those core markets, the core markets for ETH and USDC and EURC and CBBTC. And then we've also just recently launched a pilot for Oracle extracted value on Optimism Ethereum network with Solidity Labs. And that is actually generating additional protocol revenue through a MEV tax. I'd encourage you to read more about that. There's a link to it in the forum post. But we've seen the first few successful liquidations on Optimism already. And I believe we are the first protocol to actually implement OEV that in a fully on-chain decentralized auction, using some of the cutting edge research provided by Paradigm. Dan Robinson and his team there at Paradigm have produced this cutting edge research. And, thank you to Solidity Labs, to Elliot and Anna for basically taking that research and running with it and creating a really solid proposal. And that'll most likely roll out to all of our markets in the coming weeks through governance proposals. And then also we've launched these new markets for Lombard BTC, and the CBBTC Frontier Vault, which has a more moderate risk level, will supply into Lombard BTC on the Morpho side. So Lombard BTC and Babylon in general, if you're familiar with EigenLayer, it's very similar. It's Bitcoin restaking. So EigenLayer added $30 billion of TVL to Ethereum mainnet last year. We believe, or we have a thesis, that Babylon could add 100 billion or more TVL to Ethereum on Base and other layer twos this year, just because it's Bitcoin restaking, and Bitcoin has the greatest economic security of any asset in crypto. So that's just a thesis we have. But I think if those markets are successful that recently launched, we'll start to see more protocol revenue generate this year. Obviously, I don't have a crystal ball and I can't predict what will happen. Markets are volatile, especially right now. But that's our thesis, is that we want to be the most capital efficient lending protocol on Base and on the super chain on Optimism as well. And basically, that's how we win against the bigger competition that's out there. So we've had this relentless focus on capital efficiency among many different contributing teams. And the question I kind of asked for the community is, where should all this revenue go? And my proposal, or our proposal, is we propose that excess protocol revenue be auctioned off for well and used to bolster the safety module ecosystem reserve. So what is the ecosystem reserve? It's a smart contract that holds protocol reserves, and it's currently used to reward safety module stakers for their role in providing essential shortfall insurance and participating in protocol governance. So in the past, there have been community posts, ideas to create structural demand for the well token. And we've considered what we think is a good design here is creating these simple auction smart contracts, which could be used to sell off excess ETH, USDC, Bitcoin, staked ETH, CB ETH, Rocket Pool ETH, Arrow, virtual LBTC, all the markets that are supported on Moonwell, and basically auction them off for well. And then after those auctions complete, the well could be transferred to the safety module ecosystem reserve to bolster the staking rewards and make it a higher APR. The general goal here would be to increase the shortfall insurance because more people would likely stake, and also to increase voter participation because if you stake, you have to vote every 30 days to claim your rewards. So I did some math here on how much this might bolster safety module staking rewards. And now this is based on market conditions a couple of weeks ago. I don't know if it still holds true today. And also just keep in mind that I did this math before Gauntlet came through with their research. And this is just based on 1 month of protocol revenue for December 2024. January was not even finished yet when I put this post up. So keep that in mind. We generated $352,777 in protocol revenue on base, according to Token Terminal. Now, not all of that protocol revenue is safe to auction off. I think that's what I've read in the Gauntlet post, and Gauntlet will tell more about that when they talk next. But let's just assume at some point in the future, it might be months or it might be a year from now, we reach a steady state where all of the protocol revenue is excess, and then it can all be auctioned off. And that's kind of what I'm assuming here. So I guess what I'm saying is take these numbers with a big grain of salt because this is napkin math. It's based on data from late January, and it makes some assumptions about protocol revenue because I didn't have the risk analysis from our risk curator yet. So if we were to auction off all of the reserves or all of the revenue generated in December, that would have led to a 3.06x increase in staking rewards, which would have been a 22.71% APR. Now, again, just caveating this that this is speculative and the actual amount of revenue we can auction off is probably not that high. So I wanted to walk everyone through just kind of how this would work. There's a diagram in here. So basically, the first step would be a governance proposal will go on chain. This would be the same governance proposals you see every 4 weeks that automate the liquidity incentives. And as a reminder, what those proposals do is basically we have automation that looks at the TVL in every market on Base, Optimism, and Moonbeam. And if you think of all those markets as a giant pie, and each slice of the pie might grow or shrink on a given month, ETH might be greater 1 month and USDC might be smaller another. It subdivides the monthly liquidity incentives among all the markets based on TVL. It also sends some to the safety module ecosystem reserve for stakers as well. So, and just to recap for those that might be unaware, when Moonwell first launched in June of 22, 15% of the total supply was set aside for liquidity incentives that are emitted linearly over 4 years until June 2026. So this is basically subdividing those liquidity incentives every 4 weeks until June of next year is when they run out. And those automated liquidity incentive proposals could actually be, we could add some calls to the end of them that basically withdraws any excess reserves from the markets themselves. In this diagram, I only show the WETH and the USDC market, but in the actual design, there would be all the markets, right? But I'm just showing that for simplicity. So the first step in the proposal, besides rebalancing the liquidity incentives, would be to withdraw excess reserves to the governor itself. The governor is controlled by, the 100,000 or so well token holders. And then the second step, again, all in the same proposal, would send that ETH and USDC and other tokens to these simple auction contracts, and then would initiate the auction, which would run over 2 weeks period of time. Now, the auction contracts would start with 100% ETH or USDC or whatever asset is in the market. And at the end of a 2-week auction period, they would end up with 100% well. And so, we were trying to think about like, how could we design this in such a way that it wouldn't be attacked by MEV bots? If we were to send the tokens to a DEX or something and swap them like Aerodrome, then it would likely be that some MEV bot would front run the governance proposal because it basically passes 5 days after it's proposed. And so we thought this simple auction contract was a great idea. Actually came from a contributor at Solidity Labs that proposed this, that had done this at a previous protocol they worked at. And basically, to try to explain the auction in a simple way, is that it would start at the current Chainlink price plus maybe 20%. We haven't figured out what that exact amount is. We'll put in the governance proposal, but it would just decay over time, the price that people would pay, until at some point a MEV bot or some kind of automated system would come swap it for well. And so it actually gets subdivided into 84 different mini auctions that run for 4 hours each. And each mini auction starts at the current Chainlink price for that asset, and then it slowly decays over the 4-hour mini auction duration until some market participant decides to swap well for that asset. So by doing this over 2 weeks, we think it's actually a good design, and we've gotten feedback from others. We've asked some people on the CalSwap team, for example, and on some of the teams that work on decentralized exchanges, and they seem to like this design. It's probably not perfect, but it seems to give us like a time-weighted average price over 2 weeks for well, or for these assets that are swapping for well, and then basically at the end of the 2-week period of time, there would be 100% well on the contract. If anyone in the community, by the way, has better ideas on how to do this, we're all ears, and we'd love to hear your ideas. And please reply to the forum post and let us know. But that's the general idea. We would have these little mini auctions that would run over 2 weeks. And then the next proposal that would go up 4 weeks later, the next liquidity automation proposal, would basically sweep all the well out of those auction contracts, send it to the safety module ecosystem reserve, and then set the staking rate to whatever higher percentage than it would normally be. And then, of course, step 4 in this is that people in the safety module can claim the rewards anytime they want, just like they can today, as long as you voted in the last 30 days. So, wow, that's a lot of stuff to unpack. And then I want to just kind of end with open questions. So, I'd asked Gauntlet and Block Analitica, B Protocol, and other risk-focused contributors, what should we keep in each market as a healthy level of reserves? And Gauntlet has come back with some really excellent research on that. There are some markets like Arrow that have generated 7 figures of protocol revenue, but a safe reserve percentage is probably different for each market. I'm not a risk management expert myself, so we're relying on Gauntlet to keep us safe, as they have for the last 3 years. And then, should we fully distribute all the well obtained through auctions to safety module stakers every 4 weeks? Or should we try to cap the staking APR at some lower level, like 20% or something? The reason for this, I got some feedback from some of the contributors that we might not want to have a higher than 20% staking rate. We might want to keep some of the ecosystem reserve, because maybe during a bear market we want the rate to still be high, or maybe we want to keep some of the ecosystem reserve because it's part of the insurance policy, the shortfall insurance. So I would love to hear your thoughts. And again, please feel free to come to the forum, leave your thoughts. We might have time for Q&A, I think, in the space. But let me just turn it over to Gauntlet. And Sai, are you online? I think you're the one that's going to talk from Gauntlet about the reserve levels.
Yeah, thanks, Luke. Really excited about this proposal. And yeah, I just want to add more thoughts on our end on how we see and envision what these reserves could be, and what's like the best way to increase capital efficiency, but not at the cost of risk. So kind of want to dive into some of the analysis that we've done at our end. And just to like start off, the way we're thinking about this is what is like the maximum reserves that are required at the current market conditions in case of like more than like 6 sigma, or maybe the worst case tail end scenario. And that's where we started our analysis at. And we're going to like backtrack on how we envision what these numbers are going to look like later down a few months or maybe a year. But to kind of dive in deeper, we first want to see where the risk potentially stems from within a protocol. And that's actually an asset's borrowing capacity. Now, we could use the TVL as a metric to maybe get a proxy of what the reserves need to be, but we feel borrowing capacity is much more deterministic. It kind of showcases what an asset's borrowing power is, and what if this asset were to either depeg, or if the users who are borrowing against this asset were to default, what the insolvency is going to look like. So we first defined the borrowing power as supply cap and a multiple of collateral factor. So that's where we start off this analysis with. And we believe this represents the maximum risk the protocol faces, or maybe the highest potential debt that can be insolvent for a particular asset, given suppliers default on their obligations. Now, that's the first part of it. The second part of it is the annual reserve growth. which kind of acts like a buffer. So if you have an asset that's onboarded onto Moonwell, we definitely don't want to start selling these reserves immediately. We definitely want to give it some time to accumulate these reserves, and we believe 1 year is a suitable time frame for this aspect. And most of the assets on Moonwell have been listed, like the blue chip ones have been listed for quite a while, and I assume they meet this buffer as of today. But for any new asset that's listed on the protocol, I think this is a good buffer to ensure that these reserves are not sold prematurely. So that kind of compromises like the second part of the equation. So we believe like the minimum required reserves is borrowing power, some discount factor, which we term it as a shortfall percentage, and the buffer, which is the annual reserve growth. So I'm going to like dive in deeper into what this shortfall percentage means. So we know that since not all borrowers default at once, and liquidations are not always unsuccessful, and we already have the collateral factor, which serves as a decent buffer, we believe like the shortfall percentage can be about 10% market-wide as a pretty conservative proxy for what the maximum risk is actually realized. Now, if you do the math, we get to a certain value, and anything excess of that value could be labeled as excess reserves. I'm going to run through one example. Let's say you have an asset that has the borrowing power of 10 million, which is supply cap into collateral factor. You get this value 10 million. We observed the shortfall percentage to be 10%. And given the projections, let the reserve growth rate be 100K a year. And now if you were to do the math, you'd probably get 1.1 million as the minimum required reserves. But if the reserves already have around 1.5 million instead, so there's excess of $400,000, and that can be auctioned. But this is basically defining the highest bound of what the reserves need to be. Obviously, we don't have to be that conservative in our the spectrum of risk. So we would want to like highlight that there's this other aspect, which is the value at risk that we've showcased in our dashboards, and is kind of the more closer metric for what the actual insolvency would look like. And over the past 6 months, this metric hasn't exceeded 1 million for the base instance of Moonwell. And rounding up the math for all the shortfall across all assets on Moonwell, we basically arrive at a number which is around 33 million. And that's over 30x multiple of what the VAR is suggesting. So that's basically pretty conservative, but we believe this is a great starting point for the risk reserves to be at. And over the course of time, that multiple would be adjusted based on market conditions. Yeah, basically, we'd probably see this multiple to kind of gradually converge from 30x to maybe some 3 or 4 or 5x of the current VAR across market. So yeah, so that's basically our rationale as to how we're approaching what the minimum reserves need to be. And we'll be monitoring these conditions, all these risk parameters across all assets, and be tweaking them, refining them further to kind of gradually converge to what we actually want to realize in terms of what the reserves need to be. But yeah, that's basically a quick rundown of our methodology here. I'm open to any questions that the community has.
Let me jump in really quick before we go to the next topic or turn over to questions. Yeah, just one. I think, we actually met with Gauntlet yesterday just to discuss this, and wanted to just kind of highlight a couple things. First of all, thank you for doing this analysis. This was very in-depth, and I appreciate you sharing all the math with us. As I understand it, and I'm just trying to summarize like my understanding because it is a very complex topic, and some of this even goes over my head. That's why you guys are the risk management experts in our community. And so, as I understand it, the approach we're taking right now is a maximally conservative approach, which is to basically look at the supply cap, which I think in the case of ETH is like 90,000 ETH, and then multiply that by the collateral factor, which is 84%, I believe, and then that gives you some upper bound of what the maximum could be borrowed, and then we kind of want to basically kind of have a shortfall insurance that would cover that, which is over $25 million. But there's actually quite a bit of, we only actually have half that much roughly ETH supplied, so that we're not at the supply cap. And so there's this is quite a conservative number, but it's probably a bit too conservative right now is my takeaway. But also I understand that we want to do things slowly, and this gives us an opportunity to test the system for the first few months and then slowly ratchet things down to where we get closer to the value at risk. Is that a fair takeaway, Sai, or like I just want to kind of summarize for the community, but if I'm saying things incorrectly, please step in.
Yep. Yeah, that pretty much that's a good take, and I can agree with that summary, Luke. It's as of now we've taken the worst possible scenario, and honestly, the probability of that realizing is over like 6 sigma standard deviations, or probably even more. But we want to like start off at this level today, and then gradually ratchet it down over the course of the next few weeks or months to a level that we believe is more likely to be realized, and we should be able to have that reserves to cover that kind of insolvency, essentially.
Okay, and then one final question for you. Are there any markets, for example, like the deprecated markets, which would be USDBC and DAI, I believe, on base, and then WBTC on Optimism, where it might be safe to start earlier? What is your take on those?
Yeah, I think with respect to USDBC, DAI, and Wrap Bitcoin and Optimism, we believe it's safe to start moving those reserves or auctioning those reserves off for well, considering that we've pretty much deprecated these markets in terms of risk. So there's no outsized risk or exposure to the protocol that will be stemming from these assets. Yeah, we believe we can auction these assets for well.
Okay, thanks. I think that's all the questions I had, but I'll turn it over to the community. Also, I think this gives us a great opportunity to kind of test the system on a lower stakes auction for those deprecated assets before we expand the risk by moving to other markets. Thanks.
All right, thanks, guys. Yeah, anybody in the community, if you have any questions, let me know. Andrew, was there anything you wanted to add on, whether it's about this topic or about the monthly recommendations?
Yeah, I've got some monthly recommendations for us to kind of run through here. Sounds good. So let's start off with base here. We've had some supply cap increases for RSETH and RETH. We're seeing a lot of stable liquidity conditions for both these assets, and some of the largest suppliers are primarily using it to borrow stablecoins or WETHs. We think bumping supply caps here accommodates more growth while maintaining safety margins. But of course, we're going to continue to monitor these markets. Noting also that we had a supply cap rec for well increases here from 75 million to 150 million. Supplies have shown really strong demand, and we're seeing community really loving this market. So we're monitoring it very closely, making sure that we are staying on top of liquidity conditions as well as user demand. Regarding borrow cap increases on base, we see RETH, we recommended moving from 450 to 900. There's been very strong demand for RETH recently. If you've noticed, there's a huge utilization spike for the market. And so with us evaluating the liquidity conditions on chain, we think it warrants an increase in the borrow cap here. So recommended doubling the cap here, but of course, we'll continue to monitor the markets. Regarding interest rate curves, I do have a recommendation for USDC. In January, the Sky savings rate moved to 12.5%. So we're asking and recommending to bump up about 50 basis points to the borrow APR at the kink. You'll see also that our recommendation for the multiplier to increase from 0.061 to 0.067. The goal here is to keep stablecoin borrowing competitive while maintaining liquidity and ensuring healthy utilization levels. Just want to note here that we're not applying the same rate of change to EuroC. The usage patterns and the utilization rates here differ very differently from USDC. Just wanted to note that mainly this is a USDC change. We also looked at CB, BTC, and utilization here remains fairly low, even after we've had a few adjustments to the kink and borrow APR. So we've recommended optimizing for supply APR here to match the broader market rate. Acknowledging that the current environment for increased supply here and declining borrows, so we need to re-engage with the market and try and tweak demand. So we're encouraging some borrow demand here without overexposing the protocol. You'll see the multiplier increase from 0.045 to 0.07. So we're going to monitor these changes here and see how the markets respond. We also, as Luke mentioned, already had some really big markets listed this month. We've seen LBTC, TBTC, USDS, and virtual markets all live on base now. So we provided recs for initial supply caps, and we're seeing some decent uptick in these markets. So really excited to see these assets grow and go live on Moonwell. A lot of work to get these assets and markets live. So really appreciate working with the Moonwell team here and providing some new options for base participants. All right, switching topics, let's look at Optimism. We've got some supply cap increases recommendations. Starting off with WETH, we moved from 540 to 860. We noticed that the top 10 positions here are mostly recursive, and liquidity appears fairly sufficient to handle increased supply. So we feel like it's pretty safe to expand the supply caps and support further demand in a risk-adjusted way. Also looked at Velo. There's adequate DEX liquidity here to handle, some liquidations. So we think moving from 35 million to 42 million makes sense. We have some pretty conservative collateral factors here, and liquidity is fairly deep on Optimism. So we think this warrants a move in the supply cap. For Velo, also, we increased the borrow cap from 10 million to 20 million, mainly the same rationale. There's been some very high user demand, so we want to make sure we accommodate growth in a risk-adjusted way. And so we'll continue to monitor Velo as an asset. We do want to note, like with the recent market volatility, that users are taking advantage of these positions, but it's still within our risk framework recommendations. So we are feeling pretty good about where things sit, but we'll continue to monitor the situation. We also have an increase in WETH. So we increased the borrow cap from 9,500 to 11,000, just to align with utilization trends near the kink, giving a bit more room for borrowers to increase position sizes. We also recommended increasing the WETH, sorry, I sometimes have a hard time saying that, from 74 to 78, just to match the base market collateral factors. The large positions here are really recursive, so our recommendations for CF increases include buffers for significant price volatility, but definitely warrants a change just due to user demand. I think we've already touched on WBTC deprecation, but we're effectively phasing it out. Collateral factors, we recommend to move down from 10 to 0.1%. This won't result in any liquidations. We'll significantly reduce protocol exposure from a risk perspective here. Also, last thing on Optimism, we have an interest rate adjustment for USDC, DAI, and USDT just to align with our base recommendations. Just moving 50 basis points at the kink, just mirroring our rationale here on base, keeping up with user demand for leverage while ensuring we have stable utilization rates. Moving over to Moonbeam, we only have one recommendation here, which is to continue tightening the collateral factors for the wormhole assets just to bring down the risk exposure on the network and liquidity fluctuations on chain. So we're moving USDC down from 39 to 36, WETH down from 33 to 28, and wrapped Bitcoin from 14 to 11. And we looked at Moonriver and didn't see any changes that were needed here. So we don't have any recommendations on the Moonriver side of things, but of course, we'll continue to monitor the markets and make adjustments as needed. I do want to point out, we are very open to community feedback, and we want to hear from, Moonwell participants here. So please provide feedback in the forums or recommendations, ask us questions, or DM us directly if you'd like to hear more about kind of what we do and why from a risk perspective. But that's all on my end.
Yeah, Andrew, let me jump in here. I have a question for you, and it's okay if you don't know the answer right now, but I just wanted to ask. I think you had mentioned in the past that it might not be safe to increase the well borrow cap until we increase the proposal threshold for governance, just to avoid people borrowing well and putting up a spam proposal or something like that. But I guess I just had a question. What would you recommend that proposal threshold be? Do you have any thoughts there? And like I said, it's okay if you don't know the answer right now. I'm kind of putting you on the spot here.
Yeah, so we did talk about that. Right now, our recommendation is mainly to support the supply side for well, but we do note that there is an opportunity for someone to provide a governance attack. And so I don't think I have a recommendation on the spot, but we can definitely look into what that threshold needs to be to keep protocol safe. I think it would probably be a multiple of the current situations because we did increase the supply side by a decent amount. But I can get that number to you here pretty soon.
Yeah, just let us know maybe before the next community call. It doesn't have to be right away, but I think contributors like us would like to know what we should maybe propose that be changed to. Obviously, balancing the need for the community to be able to propose changes to the protocol, because if it costs 100 million to propose, that's probably too much. But I think it's like 1 million now, if I'm remembering correctly, and that might be too low. But yeah, feel free to get back to us and let us know what your thoughts are from a risk management perspective.
Sounds good. Definitely aligned with keeping the protocol safe. And I think, like we outlined here, we increased the supply side by a lot, but the borrow has not been moved yet. But yeah, I can get that number to you soon.
All right. Thanks, Andrew. I apologize. I'm going to have to jump around topics a little bit here due to time constraints. DeFi Nicola, if you have time, if you want to give the Block Analytica monthly recap updates, are you free to do that now?
Yeah, sure. Thanks for the invite, first of all, and hello to everyone. DeFi Nicola here from Block Analytica team. We are doing a risk curation on the Moonwell isolated markets, the Moonwell morph vaults on base. So just wanted to run through a couple of highlights from January. In January, we saw a significant increase in Ether borrowing demand, and to be precise, we saw a 24K of ETH additionally borrowed in January, mainly on the largest market, on the rep-staked ETH market, which resulted in our Moonwell flagship Ether Vault APY increase from 0.25% to over 2%, and this is native APY only. If we count in the well incentives, the current APY is over 4%, meaning that you can earn over 4% on your Ether holdings on Base by depositing to our vault. Also, a quick reminder that we are kind of keeping the collateral listings only to the blue chip ones and having the sort of conservative risk approach when it comes to flagship vaults. So yeah, this lending ETH via our vault, it's going to be basically lent out to a couple of blue chip collateral assets. Yeah, next thing, and probably the biggest news from January, was that the Coinbase integration of Morpho Markets on their main app. On January 16th, Coinbase announced the integration of the Coinbase BTC USDC Morpho Market on Base as part of their TradFi in front and DeFi in the back campaign, which is allowing users to borrow up to 100K in USDC, and they're kind of rolling this out slowly. So yeah, this also resulted in the USDC borrowing demand spike, as we saw now 3 weeks since the announcement, over 40 million of USDC additionally borrowed. We are having around 1/3 of the supply share in this market with our Moonwell flagship USDC vault. So yeah, generally, all in all, just saw a significant borrowing demand increase. That also goes for our newest vault, the Moonwell Frontier Coinbase BTC vault. And here, to be more specific, I want to point out that the Pendle PT Lombard BTC market with the May expiry date has actually now over 10 million in Coinbase BTC borrowed. So yeah, demand slowly but steadily growing on that market as well. And this new vault of ours also seeing an increase in APY. Yeah, to conclude, I also wanted to mention the proposal we put up 6 days ago for launching the Moonwell flagship USDC vault on Optimism. Basically to, of course, in collaboration with Moonwell DAO again, and with the same setup of vaults we have with the Moonwell DAO on Base, basically to capture the first mover advantage and to seek for grants on Op mainnet. I'm sure Luke will have some additional data regarding that and info regarding that to add. Yeah, you can check it up on the Moonwell forum. And yeah, I think that'll be it from the updates from Block Analitica.
Yeah, thank you, DeFi Nicola. First, let me just address the last topic you just mentioned. So Optimism Foundation met with some Moonwell contributors, including myself and Solidity Labs and others, just recently in the last week. And we learned that they're going to be launching a very big stablecoin campaign to attract stablecoin liquidity to all of the layer 2s on the superchain, including Optimism mainnet, but also others that are newly launched. You know, these are chains like World Chain, Inc., Zora, Mode, Sonium, and even Unichain, which hasn't launched yet. But they shared some data with us that showed that stablecoin liquidity has grown really rapidly on Base, but all the other Optimism layer 2s and even Arbitrum has lost stablecoin liquidity, mostly to Base and Solana. And so they really have a goal of, you know, driving large stablecoin growth across the superchain, not just on Base. Coinbase is doing a great job on the Base side. And we've been, you know, obviously our vaults are really helping because they're powering that new Coinbase Bitcoin Borrow product, which, you know, that's very strategic for us. We've been partnered with Coinbase for 18 months and helping them to kind of behind the scenes, helping them to launch that product and helping them to get Coinbase Bitcoin live so that their retail users could borrow USDC right in the retail app. And that actually taps into the Morpho markets in our vaults. But this campaign with Optimism is very exciting because, Optimism acknowledges that they haven't done the best job of promoting DeFi across the superchain. They've been more promoting, new layer 2s that contribute sequencer revenue to Optimism. But they realize that they need to focus more on stablecoin liquidity, especially because that's really what is going to drive growth and help us compete with Solana as an ecosystem, right? And so for all of those that are superchain builders like us, it's really music to my ears. And that means that Moonwell will have the opportunity to kind of apply for multiple OP grants in the coming weeks and months. And I know that contributors like Magin and Crizzy are going to be helping to draft those governance proposals. So we're super excited about that. Also, we'll have some, I'm sure, super delegates like Derek and others like Cool Horschel and others will probably help with drafting some of these grants, just because we want to make sure we get the most OP incentives we can. And this brings us to the opportunity to launch a new Morpho vault on Optimism. So we're excited to do that because we already have our token live there. We already have governance live there. So Morpho just deployed the factory contracts there, which allow Block Analytica to basically spin up the vault and the isolated markets for that vault. So we hope to activate a USDC vault, an MW USDC vault, just like the flagship USDC vault on Base, but on Optimism, and tap into some of those grants. The only challenges really are that there's no Morpho front end, and there won't be a Morpho front end for probably months. So we'll have to basically, extend the Moonwell front end to basically cover that. But, I think contributors like SolarApe and others have built the most beautiful front end in the space. And so we're really well positioned to kind of attract the early Morpho USDC liquidity on Optimism mainnet and other superchain L2s if we ever expand to them. And so I just wanted to share that with the community. And also, there are some technical challenges we need to solve. For example, how do we get OP and well incentives to people if there's no reward infrastructure? The Morpho URD or Universal Reward Distributor contracts are not live yet. And then also, how do we index the market and vault data so we can show that into the front end? Because today on Base, we get that data from Morpho's API, which isn't available yet. So there's some technical challenges that contributors like us need to solve, but just know that we're all hard at work, across SolarApe and his friends, also Solidity Labs and also Lunar Labs, my company, and all the governance contributors and super delegates. We're all kind of trying to strike while the iron is hot and capture this opportunity to kind of become the premier stablecoin liquidity source on the superchain. So we're well positioned to do that. In fact, we keep getting outreach from all the other superchain L2s asking us, could you please deploy the Moonwell front end? And then we're going to have, we have the virtual debit card, but we're going to look at expanding that across the superchain as well, so that we could potentially offer the Moonwell card to Optimism mainnet users. And also, we're just trying to figure out how we can also bring like this virtual accounts feature that's going to be hopefully launching soon, where you can get a US bank account and incoming wires and ACHs will end up as USDC in your wallet on Base. And so we're looking at how we can extend that to Optimism mainnet and other superchain layer 2s. And Optimism Foundation has even generously offered to basically reimburse Moonwell Foundation for all the bridge fees. So that's really exciting to us as well. So, they see the strategic vision of, Moonwell kind of being the premier place to both lend and borrow stablecoins, and also with the best on-ramps and off-ramps. I think we're well positioned to kind of succeed in 2025. Anyway, I've been too long-winded, so I'll turn it over to the rest of the governance contributors.
No, thanks, Luke. That's great. Actually, hopping back to the topic, the first topic that you and Sai were discussing, we also have Elliot from Solidity Labs here today. Elliot, if there's anything that you want to jump in with that hasn't been covered yet, do you want to talk about? Feel free.
Yeah, no, I think we had a really great overview of the OAV system as well as the reserve automation system that we are going to be rolling out here shortly. So I think that maybe I could dive into some of the lower level details, as we kind of already have we did a great job of giving the big picture and how all these pieces fit together. So I guess, yeah, to start off with the addition of OEV, of these OEV oracles, basically there's a potential to add a whole new revenue stream to the DAO. UMA published research last year that looked at the total amount of funds lost to Oracle extractable value on mainnet across Aave and Compound, and they found that over their lifespan, about $148 million had been basically given to liquidators that could have been captured. And so I think that going to the Luke's point initially around capital efficiency, these new OAV contracts that we have developed, they essentially wrap Chainlink Oracle price updates, and they allow the protocol to capture a majority of the priority fees that are paid to update this price. So basically what happens is, let's say you have a liquidator bot and they are monitoring the prices off-chain on exchanges of various tokens. And so they see that the price of Ethereum has moved up or down 1%, which is going to cause some liquidation once Chainlink posts that price. So now the liquidator knows, hey, there's about to be a position that's going to be liquidated. All I have to do is wait for Chainlink to post a price update, and then I can swoop in and liquidate this loan. And 10% of the liquidation fee, it goes to the protocol, but then the rest of it goes to the liquidator. Now it's actually not that simple, because these liquidators are in a competition, so they're all competing against each other. There's multiple of these liquidators that are operating across all of DeFi, and they're all seeing this opportunity. And so then what happens is the liquidator bots pay higher and higher priority fees to essentially get the first slot in the block, the first transaction, and be the first to liquidate. And when that happens, they're paying these higher fees, and these higher fees are going to the sequencer. So they're not being captured by Moonwell. But with the new contracts we've built, the higher the priority fee is, the more revenue for the DAO. So basically, we take the priority fee and we multiply it by 99, and then that is the cut of the reserves that the Moonwell DAO essentially would get. So if a priority fee, let's say, is at 100, then the Moonwell DAO would get 100,000 or 10,000 in terms of a fee there. And so this has been rolled out on Optimism to start, and a governance proposal is in the works to roll this system out across the superchain, so across Base and across Optimism. And we've seen the first two liquidations as ETH has been volatile recently. And there was some very small revenue there. And the reason that the priority fees were so small is because we think that the liquidators have not discovered this opportunity yet. And once we roll this out to the broader set of Moonwell markets, I think this is going to be something that's really incredible for the DAO to have that, just new way to capture liquidation fees that are normally lost to liquidation bots or to the sequencer fees. And I guess then moving on to the next topic is the on-chain reserve automation contracts. So these operate in a decentralized and non-custodial manner, where excess protocol reserves that are held in the smart contract are auctioned for well tokens over a set period of time. So as Sai has been saying, there are some reserves that currently can be auctioned off in markets that are being deprecated. And so to kick things off for a pilot for the reserve automation system, we are going to basically be selling, it looks like USDBC and DAI, and maybe a couple others, but I think that's it to start. And the way that what the system flow looks like from a really high level is we have a governance proposal that withdraws reserves and sends those reserves then to these reserve automation auction contracts. Then once the assets have been moved to the auction contracts, the auctions are then kicked off by governance. And so governance can set a delay and say, hey, let's wait for the next few days. And then over the course of the next 2.5 weeks, I want you to sell off all of these assets at a bunch of mini auctions. And what this essentially functions as is a TWAP for the DAO. So instead of the DAO saying, hey, I'm going to sell all of these reserve assets in exchange for well, like right now, right this second, instead the assets are sold off over a time period, and there's multiple mini auction durations within that larger period. So we can say, okay, we're going to do 25 mini auctions over the course of the next 5 days, and then that allows the DAO to get the best pricing over the next period of time. And the way that these auctions work is they start off at a premium to market price. So we say, like, okay, if well is at 5 cents and USDC is at $1, maybe we start off at 2 times the normal price, just throwing out an example here. And so then that would mean that the auction contract would sell its reserves to you if you give it well at, and it's valuing well at 10 cents. And then over the period of the auction, there's a decay. And so then we go from a premium then to a discount. And so the theory here is that, if no one is willing to buy the the reserve assets at a premium, then they will be willing to buy them at a discount. And then all of the well proceeds that are gained from selling the reserves will then go to a holding contract, which can be used to fund the safety module and help increase rewards to backstop the protocol. And we have some really great news today. The Halborn audit of these auction contracts and the system that moves the assets around, it came back with no critical high or medium issues. So that's the green light here on the contract side to go ahead with deployments. And so I think with that, I will hand it back. And if there are any questions, I'm happy to answer them.
Awesome. Thanks, Elliot. Yeah, as you brought up with the topic of OEV, we also have Dave from API 3 here. He's a returning guest that was on our previous great OEV debate call, and he also just recently created a forum post. So if you'd like to jump on, I'll throw it to you.
Perfect. Thanks very much. Hi, guys. Thanks for having me back on. Appreciate it. And congratulations as well to the Solidity Labs guys for doing the first completely on-chain OEV auctions. It's quite an elegant solution, I have to say. So my proposal is up on the Moonwell governance forum at the moment, and it's for API 3 to provide data feeds to one market on the Moonwell deployment on Moonbeam. The Solidity Labs solution for OEV doesn't work quite as well on chains like Moonbeam, like Moonriver, where there's the potential for private MEV to interfere with it. So what my proposal is aiming to do is to offer API 3's OEV solution as a way that people participating in the markets on Moonbeam and later Moonriver can also then benefit from the OEV that these markets generate. In terms of how API 3's solution works, it differs slightly from the Solidity Labs proposal. Instead of waiting for the predetermined chainlink updates or volatility-based chainlink updates, it uses API 3's native feeds. API 3's feeds are designed around OEV. So the searchers, instead of waiting for an update, they're able to bid to trigger an extra update. They can then use this update and bundle it with a multi-call to trigger the liquidation. So effectively, it creates the same results. You have searchers bidding for the ability to trigger liquidations before other searchers, and API 3 then returns 80% of this value. The proposal actually goes into how this is meant to happen. We'd be returning it to the Glimmer USD reserves using the add reserves function. But actually, when the auction mechanism that you guys have in the works is available on Moonbeam, that seems to me to be a more elegant solution. So we can always amend the proposal for that in future. So 80% of the OEV revenue goes back to the protocol, 20% is split between API 3 and the data providers. In terms of what this looks like, we've actually had our feeds live for quite a while, I think over 6 months, and the current iteration of OEV is incredibly effective at returning value. We have, one of our users is Compound on Mantle. They use us for all of their markets, and they returned just over last weekend with all the, well, over the last week with the volatility. They had $150,000 returned to them. So, and they only have 11 mil TVL, including Boris. So actually, I think it's 17 mil, including Boris. So they're much smaller than Moonwell on base, smaller than Moonwell on Optimism, larger than Moonwell on Moonbeam. But it's what I'm trying to say is that this is a proven solution for OEV. It does work. It does return significant value. We did some maths for what it would look like if Compound on mainnet was using it for Compound, and it turned out it would have been over $4 million for the same period of time. So it works very well. It handles liquidations very well, and we would like to prove that by taking on one of the markets on Moonbeam. And we proposed the Glimmer USD market because it is sufficiently volatile, and we have to obviously provide the reserves in the gas token of the chain, so it works well operationally for us. The aim for us, once this works and we can prove that it works, would be then to put up a proposal to take over the other markets so that people who are staking in the safety module on Moonbeam have much higher returns from the returned OEV. And that's it really. The proposal goes into more detail, but I really would encourage Moonwell stakers to look at it, read through it, ask any questions either now or on the proposal, and to vote yes. The other thing here is that if we can prove to you guys, to the Moonwell community, that API 3 are a reliable Oracle partner, where there are chains that Moonwell want to be on that either other Oracle partners are unable to or unwilling to operate on, API 3 can step in, and we'd love to support you guys as you expand and grow the Moonwell protocol. So. And that's really all I had to say. So hope you'll vote yes when it goes up for snapshots. And if you've got any questions, then now's a good time to ask them.
Thank you, Dave. If the Avail team is here, you can request to speak. But if not, we'll wrap up with ZeroX Mims talking about the virtual core market. If you're here, Darren.
Yeah. Hi, folks. So recently I put up a proposal to list the virtual token as a core market. And for those unfamiliar, Virtual's protocol is an AI agent launchpad that has taken base by storm, and it has achieved what a lot of people would say was would be unthinkable, which is taking mind share from the meme coin narrative. And so while AI agents can be argued as part of the meme coin narrative, whatever, I think that's going to evolve as a space, and it's going to diverge very quickly. And we'll see like new and improved capabilities very, very soon. But anyways, I'm getting off topic. I think Moonwell is in a great position to list this asset. And once again, it's one of the largest growing ecosystems on Base right now. And as for the virtual token itself, I think the virtual token works with this really nice mechanic where per agent launch on the launchpad, the token for that agent pairs with the virtual token itself in the liquidity pools. So there are a few cool angles there. So if there are any questions about that proposal, feel free to reach out to me. If there are any ideas for future listings, please let me know. Or if there's just general help anyone needs, feel free to send it my way. Thank you.
Hey, thanks for getting that proposal up. I really appreciate it. By the way, I just wanted to mention really quickly, I know we're over time on this call, but I've learned a lot about Virtual and their AI agent platform in the last weekend because some of the Moonwell contributors and I went to the Coinbase AI hackathon in San Francisco. If you want to learn more about what we did there, just please check out my Twitter feed. I think I have it pinned to my profile. It was a really exciting hackathon, and we actually won the grand prize on both the Coinbase side and the Virtual side. I think we won over $10,000 as a team there. It was really an epic weekend. And, first of all, thank you to Elliot and Nana from Solidity Labs, and thank you to even some new Moonwell contributors. Well, they're not even really Moonwell contributors, Hish and Nick, his friend from tribes.xyz, and they also are founders of memecoin.new, which is a new meme coin launchpad on Base. But anyway, it was a really epic weekend. Also, we just had, a team of like 5 cracked developers basically building all weekend, and we got a chance to meet the Virtuals team and talk to them. And we built what we think in just a weekend, what we think is the hottest yield-seeking agent on Base. And Mamo is what we're going to rename her to. Mamodiko it doesn't exactly roll off the tongue, but watch the demo in my pinned post, you'll see it. But what I learned is that the reason why Virtuals is such a strategic market for us as a community is that in order to launch an agent on Base and be part of the platform, you actually have to start with 100 virtual, and then you need at least 42,000 virtual to actually appear in the portal. So those really successful agents like AI XBT, who you might have seen on Twitter, posting all the time, those successful agents actually have bonded, and they've created an LP pool on Uniswap with their agent token and virtual. And so this allows AI agent creators to actually borrow virtual and launch their own agent without having to go buy virtual on the open market. So that's why we think it will be a really hot market, in the same way that Arrow was a really hot market for us on Base. And again, it just reinforces our focus on launching the best Base native assets and just being the best place for lenders and borrowers on Base. And so I'm just really excited about that. We're digging in on Mamodiko, and actually, some of us are just going to we'll launch her in a sandbox mode where you can give her up to $10 USDC and just let her find the best interest rate across the Moonwell Morpho vault and market, our core market and our Morpho vault, sorry. So excited about that. It's just a side project that we thought was really fun. And, worst case scenario, we learned some new AI tools, but best case scenario, Mamo becomes the hottest yield-seeking agent on Base and also brings a lot of TVL to Moonwell. So Mamo is now the newest contributor in the Moonwell ecosystem, and I'd encourage you to just chat with her on Twitter, and she'll actually reply to you. So it's pretty epic. Anyway, hope you guys have a great day. It was just a fun weekend, and we're really enthusiastic about the possibilities of DeFi AI agents. And then another thing just to mention in closing is that there's some really good Masari research out there about DeFi AI. I don't know how to say that, but you should read that Masari research if you're interested in learning more. Thanks.
Thanks, Luke. I saw Ankur from Avail. You just joined. If you want to wrap for us today, you're more than welcome to.
Thanks. So I'll not take much time. I'll just take maybe 2 minutes. So basically one of our community member has put down a proposal to list Avail on the base Moonwell market, right? So essentially, so Avail essentially is a layer 1 blockchain. It's a data availability layer. It has a lot of other components, and when it comes to DeFi utilities, Avail can be bridged from Ethereum, from Avail mainnet to Ethereum, and from Ethereum the token can be bridged to Base via wormhole. Right? So on Base, we have a liquidity pool right now on Aerodrome, which does around 500k volume on a daily basis, and to expand the utility of the token on Base, our community thinks that we need to have a market on Moonwell, and the proposal is there. There are a lot of details I can talk about in terms of what we have in mind in the future. Like, for example, we have a liquid staking protocol on Ethereum, and that protocol also plans to expand to Base and so on. But for now, I would just request everyone to just go through that proposal and shoot out all the questions, feedbacks that you have, and we will have the community to respond, the team to respond, and hopefully get the token listed.
All right. Thanks, Ankar. All right. Apologies for running long today. Have a good weekend, everybody. Cheers.